Hello everybody, this video is entitled Stretch Works, MSTR stock, Stretch Works, and we are in day four of this working as we open on Friday morning. This is going to be day 4, and I just want to spend a second talking about the relentless ATM day that we must have had yesterday, first day. You can see that blue line I drew right here, that's 100.00, right? The level at which EATMs is 100.01. Look at how relentlessly Stretch wants to go past 100, sometimes going as high as 100.02, 100.03 cents. So imagine if you have to take it from 100.03 to 100, well, how many millions of dollars of ATMing is that to take that down on an asset, which is now closing in on $3 billion, the size of that asset? Imagine how much that is. Imagine especially after hours. So whenever the markets close, the ATM stops. Saylor stops ATMing when the markets are closed. And then at what point Stretch trades at 100, 100.08, maybe 100.09. I think this is going to create interesting dynamics where if people can short with after hour price, they could potentially make a few pennies, creating more demand for this asset. It'd be a very weird asset if during market hour it trades at 100, but after hours it trades a few pennies above 100. That'd be interesting if you ask me. Like I said, this is if Friday, so if today becomes the same, if today is the same as the past 4 days, we will have had 4 full days of ATM. Now, I will be very curious to know how much he was able, of course, to ATM on Stretch and how much he actually buys when he announces on next Monday. That will be a very, very interesting thing to know. I'll be very interested in knowing that, because then we can extrapolate how much of that ATM we're going to get on a yearly basis. And as I've said before, I think Stretch, I think in the medium term, 6 months to a year, 500 million to $1 billion a week, I don't think is that far-fetched given the demand for this asset and given the positioning of this asset. I may be off. It could be more than that, because Stretch is a black hole. Stretch is a black hole that Saylor created to go partially after the bond market, but especially to go after the currency market being money market accounts, bank deposits, things that are super, super stable. And that's why the whole point of Stretch is to try to have next to no volatility. I think the volatility of Stretch right now is probably around 1%, even 1 to 2%. It's very, very low vol, and of course, if we keep trading so close to 100 for a long while, we're going to get below 1% volatility. And I think for most people, it's going to be okay. For most people, they're going to treat it like a money market account. If some people really want to lose no money, as I've discussed before, then they have to partner with a bank, and the bank gives a yield. And that's why Saylor, I think, has been visiting JP Morgan and all the other big banks in New York, because you would need a cash buffer. So if people wanted no volatility whatsoever and a high yield, they would need to partner with a bank. I think Saylor is working on that instrument. Next, that instrument really for risk-averse folks, for retirees, for people who want nothing at all to do with investing. But for the average person, Stretch with 1% volatility is more than enough to handle. People can handle that. And Stretch, of course, as I've called it before, I think I'm going to use that name in the future. It's a Santi stablecoin, so 100 Santi stablecoin, that trades on TradFi rails. It's a TradFi rails Santi stablecoin, And by TradFi rail, I mean you can own it in a brokerage account on your Schwab, and let's say you're tired with Schwab, you want to switch to Robinhood, you can transfer through ACATS, you can transfer from Schwab to Robinhood or whatever. So it's still portable, it's still yours, it's still highly regulated, but it's regulated on the slow, old world TradFi rails. But it is a stable coin designed to trade at 100, so a Santi stablecoin on TradFi rails that pays you 11% right now. And of course, it's paying 11% because this instrument is designed to suck air out of the room. It's designed to take the funds out, of the bond market, to take funds out of the deposits, of the bank deposits. Stretch competes. It's a highly capitalistic moment for the industry and for strategy. That's why strategy called it the iPhone moment. I believe it is the iPhone moment for strategy. All of a sudden, you have an instrument that's stable, that pays 11%. That's what everybody wants in the market. And so that's why the revolution of Stretch in that sector is similar to when the iPhones dropped and disrupted the cell phone market back when Nokias were popular. It's the same idea. When you create a product that is 10x, 100x better than what currently exists. And I would argue for Stretch, it's 10x better. 10x better. If it's 10x better, people will flock to it because it's that much better. And of course, people just need to figure it out. People need to learn about it. People need to understand how return of capital works and why Stretch is actually tax deferred, which means that at 11%, you're not going to pay taxes for about 9 years. And then in 9 years, you will pay taxes. Now, think about, if you're retired in your 70s, you're really happy about that, aren't you? Because in 9 years, you're like, whatever. Right now I'm taking it tax-free. I think most people like that tax-deferred aspect of it, and then it's no big deal. Then in year 11, year 12, you pay your taxes. It's not a big deal. And it allows you, of course, to compound early. If you reinvest that 11% yield tax-free early, you can compound in the most important years. That's another aspect. You can take that cash payment and compound in the most important year. This is really the iPhone product of finance. This is a revolution in my view. The preferreds all are in a way, but especially Stretch. It will be interesting to see if he's able to pull off a Stretch-like instrument in Europe as well, right? You could have that same setup in Europe. The problem is they don't have the ATM setup quite well done right there, but still, I think this is a revolution. I think this is particularly interesting. And MSTR, let's conclude the video with this. Stealth recovery, so depending on where you look, MSTR is up, 7 to 8, to 9%, up to 9%. Let's call it 8% roughly return. And note that Bitcoin is only up 2% over the same period. So Bitcoin up 2% over the same period, strategy up 8% over the same period, which means that the common MNAV is recovering. We're at 1.10. Remember, we fell to a 1.05, so this is a nice recovery. And of course, MNAV recovers at the very point where Stretch starts to work and where common MNAV is not going to matter at all, because if Stretch works, there's no reason for Saylor to do common MNAV anymore. There's no reason for Saylor to do, it's not dilution, it's accretive dilution. But, TradFi, unfortunately, can't spend 5 minutes to do some math and figure out why dilution is a good thing for strategy. And of course, they just say, oh, dilution, it's a good thing. Dilution on the common MNAV has been a good thing. Even at 1.05, it has been a good thing. But people can't sit down and do math for 5 minutes and actually calculate why it's a good thing. And Bitcoin shenanigans continue. Again, going back to thinking like a true Bitcoiner, following the day-to-day price action of Bitcoin is entirely pointless. This is a 4-year asset. This is a long-term asset. At night in the US, Bitcoin crashes. That's what happens. So anyways, I'm publishing this video early today. I am on my way back to the US, so happy to come back. And this video, as usual, was not investment advice, not financial advice. This is only entertainment. I'm hoping you were entertained. Please like, please subscribe, follow me on Patreon, follow me on X. Thank you for watching, and have a wonderful, wonderful day.